Artificial intelligence is now a serious force in global economic forecasting, not a buzzword, but a measurable driver of growth. That is the central message from the International Finance Center, a research institution that tracks global economic and financial trends, in its outlook for the second half of 2026. The center points to AI investment as one of the primary engines keeping the global economy moving. Spending on data centers, chips, and software has been supporting demand across multiple industries. Analysts broadly expect that momentum to hold. The shift here is significant. AI has moved from a speculative theme to something economists can actually measure in output and productivity numbers. But the center's report does not stop at the good news. It identifies 3 risks that could complicate or even reverse that growth story. The first is oil prices. Energy costs are a classic pressure point. When oil rises, inflation picks up across the board, at the pump, in transport, in manufacturing. That forces central banks to keep interest rates higher for longer, which squeezes businesses and households at the same time. The second risk is the US dollar. A stronger dollar creates particular problems for emerging market economies, countries that borrow in dollars or export commodities priced in dollars. When the dollar rises, those debts become more expensive to service and trade becomes harder. It is a pressure that can build quietly and then hit hard. The third risk is interest rates themselves. The US Federal Reserve and the European Central Bank have both kept borrowing costs elevated to bring inflation under control. Inflation has come down from its peaks, but rates are still well above the near-zero levels that defined most of the 2010s. That means higher costs for companies financing operations, for households carrying debt, and for governments managing large borrowing loads. The cushion is thinner than it was. What makes the second half of 2026 genuinely difficult to read is how these forces interact. AI investment could lift growth meaningfully, but an oil shock, a sharp dollar move, or a policy mistake by a major central bank could offset those gains quickly. None of these risks is hypothetical. All 3 are live. The International Finance Center's outlook is not a forecast of crisis. It is a map of the terrain, where the growth is coming from and where the pressure points are. That kind of clarity matters when the variables are moving in different directions at once. For anyone tracking markets or the broader economy right now, the practical takeaway is straightforward. Watch oil, watch the dollar, and watch how central banks respond to the data as it comes in. Those 3 signals will tell you a great deal about how the rest of the year unfolds. This briefing is brought to you by First Financial News, clear, daily coverage of the economy and markets at firstfinancialnews.com.